Most Indians don't fail in investing. They quit too early. They start with hope but no structure. They hear about profits but don't understand process. They buy when everyone is excited and sell when fear is everywhere. Slowly, their money disappears, not in one big loss, but through small wrong decisions. Here's the uncomfortable truth. The market is not your enemy, your behavior is. You don't need to predict the future. You need to control your actions. Because wealth in India is not built by luck. It is built by discipline over time. And if you are just starting, there are 5 simple rules that can completely change your financial future. Ignore them and you will keep restarting. Follow them and your money will start compounding silently. Let's break this down very clearly. This video is for educational purposes only. I am not a SEBI registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Breadth. Build your financial base before investing. Most beginners make this mistake. They jump into stocks without stability. First, emergency fund. Minimum 3 to 6 months of expenses. If your monthly spending is 25,000 rupees, you should have 75,000 to 1,50,000 rupees ready. Keep this in a savings account or liquid mutual fund. This is not for returns. This is for survival. Because life is unpredictable. Medical emergency, job loss, family situation. If you don't have this buffer, you will break your investments at the worst time. Second, insurance. Basic health insurance is necessary. Term insurance if you have dependents. Without protection, your investments are exposed. Third, eliminate high-interest debt. Credit cards, personal loans. If you're paying 30% interest, investing for 12% return makes no sense. Clear that first. Only after these 3 you are ready to invest. Strong base, long-term confidence. Breadth. Use SIP to remove confusion. SIP is your best friend as a beginner. Systematic investment plan. Same amount, same date, every month. No thinking, no timing. Example, you invest 4,000 rupees every month. When markets are high, you buy fewer units. When markets fall, you buy more units. Over time, your average cost becomes stable. This removes stress. Most beginners wait for the right time, but they never start. Or they invest everything at peak. SIP solves both problems. It builds consistency, and consistency beats intelligence. Even rupees 1,500 per month for 15 years can grow into a significant corpus. Because of compounding, not because of luck. Automate your SIP. Treat it like a bill. Pay yourself first. Breadth. Asset allocation is your real strategy. Not stock tips, not news. Allocation. For beginners, keep it simple. 60% equity, 30% debt, 10% gold. Let's understand why. Equity grows wealth, but it is volatile. Debt gives stability, but lower returns. Gold protects during uncertainty. Together, they balance your portfolio. Example, monthly investment rupees 10,000, 6,000 in equity mutual funds, 3,000 in debt instruments, 1,000 in gold. Now your portfolio is diversified. If equity falls, you don't panic. If gold rises during crisis, you are protected. Beginners often go all in on stocks because they see high returns, but they don't see volatility. A 20% fall feels like a disaster, and they exit. Allocation prevents emotional decisions. It creates balance, and balance creates longevity. Breadth. Respect market cycles. Markets are not linear. They move in phases. Bull phase, prices go up consistently. Bear phase, prices fall. Sideways phase, nothing seems to move. All three are normal. Example, you invest rupees 5,000 monthly in equity. For 2 years, market rises. Next 1 year, market stays flat. Then sudden correction of 15 to 20%. Most beginners panic here. They think, my money is gone. But this is where real investing begins. Rule: never stop SIP during downturn because you are buying at lower prices. This is accumulation phase. Also, don't check portfolio daily. Check quarterly or half yearly. Daily tracking creates anxiety, and anxiety leads to mistakes. Ignore noise. Ignore headlines. Focus on process. Markets reward patience, not reaction. Breadth. Rebalance, manage tax, and scale wisely. Over time, your allocation shifts. If equity performs well, your 60% becomes 70 or more. Now your risk increases. So once a year, rebalance your portfolio. Sell some equity, add to debt or gold. Bring back to original allocation. This does two things: locks profit, reduces risk. Next, tax awareness. If you sell equity within 1 year, short-term capital gains apply. Higher tax. If you hold more than 1 year, long-term capital gains. Lower tax. So avoid frequent buying and selling. Let investments grow. Next, scaling. Your income will increase over time. When salary increases, increase SIP. Example, you get rupees 10,000 raise. Increase SIP by 2,000 to 3,000 rupees. Do not increase lifestyle immediately. Increase investments first. This is how wealth accelerates. Now, common mistakes. Chasing trending stocks. Following social media tips. Panic selling during crash. Overconfidence during bull run. Avoid these completely. Final mindset. Investing is not excitement. It is repetition. Same action over many years. That is where compounding works. 10 years, 15 years, 20 years. That is the real timeline. Not quick profit, not shortcuts. Discipline creates freedom. Breadth. Most people know these rules, but they don't follow them because they look simple. But simple is powerful. If you follow this consistently, you won't depend on luck. You will build control. Slowly, your money will start working for you. Not loudly, not dramatically, but silently, year after year. And one day, you will realize you didn't chase wealth, you built it. Your future self will thank you for your patience and for your discipline. Because in the end, that is what creates real financial freedom. Breadth. Control behavior more than strategy. Most people think investing is about knowledge, but in reality, it is about behavior. You already know what to do. Invest regularly, stay long-term, avoid panic, but execution is the problem. When market rises fast, you feel greedy. You want to invest more at higher prices. When market falls, you feel fear. You want to stop SIP or sell everything. Both are mistakes. Rule: never change your plan based on emotion. Your plan should be decided when you are calm, not when market is extreme. Create simple rules. Example, I will invest 5,000 rupees every month no matter what. I will not sell during market fall. I will review only once every 6 months. Write these rules down because memory changes but written rules don't. Also, avoid comparison. Your friend may make quick profits. Someone online may show huge returns, but you don't see their losses. Focus on your journey. Consistency beats comparison. If you control behavior, you control outcomes. Build multiple income streams over time. Investing alone is not enough. You need to increase income because higher income means higher investment, and higher investment means faster wealth creation. Start with one income, your salary or business, then slowly build additional sources. Freelancing, side business, skill-based income, even an extra 5,000 rupees per month invested properly can make a huge difference over years. Example, extra 5,000 SIP for 15 years can become lakhs of rupees. Now imagine 10,000 extra. This is how scaling works. Also, avoid lifestyle inflation. When income increases, expenses also increase. New phone, better car, more spending. Control this. Instead, increase your investment rate from 10% to 20% to 30%. This is where real acceleration happens. Income gives power, investment gives growth. Combine both and wealth becomes inevitable.